my name is Paul Hyde. I'm a broker as well as a business appraiser. I've been a business broker now and sold commercial real estate associated with businesses for 23 years, and I've done active business appraisal work for over 15 years. I'm actively involved with the Institute of Business Appraisers, one of the 4 entities that designate business appraiser evaluation designations, and I hold the Master Certified Business Appraiser designation with them. I'm one of 44 people in the country that does. I teach quite a few seminars for them, as well as train business appraisers throughout the country. I also am a member of the American Society of Appraisers and hold their designation called the Accredited Senior Appraiser. There are approximately 800 accredited senior appraisers in business valuation nationwide. My practice is primarily oriented towards litigation support, where I've been admitted as an expert witness in U.S. courts as well as state courts and also federal bankruptcy court. So my normal practice is involved with doing things primarily for some type of litigation. First thing I would do as when retained to do a business appraisal would be to send off a document request list to the client, which was going to ask primarily for a lot of financial information. And I'm going to give a copy of this to Bob so he'll have it so you can see what kind of things that we would ask for. One of the major differences, in my opinion, between a business appraisal and a real estate appraisal is a business appraiser, we're going to focus largely on the financial information. And we're not going to be looking at the property near as much. Although we are going to make a property inspection. That is important. And we will do that. But we're going to be looking at things primarily on, instead of age of the property and all those kind of things, we're going to be looking to see, is the inventory really there? What kind of stock is involved on a C-store? We're going to look for just desirability, some of those kind of things that you would look at as a real estate appraiser to try and get an idea of the risk. Business appraisals, we are considered ourselves risk assessors. In other words, we're trying to determine what is the risk of this forecasted income stream that we're going to develop actually being achieved. Key things in doing a business appraisal of any property that involves some real estate, or the real estate is owned, is you have to determine just how that real estate should be dealt with. You have 2 options as a business appraiser. One is to consider the real estate as an operating asset. And this one is usually a mistake, in my opinion, although I've seen a number of business appraisers attempt that in some type of manufacturing firm or whatever. A C-store would be a good example of that, where you could consider the real estate as an operating asset because it is required and blended with the overall business. However, as we will talk about in a couple minutes, there's a big difference between the capitalization rates to determine the value of the real estate and the capitalization rates that will be used to determine the value of the business. So if you, as a real estate appraiser, use the same capitalization rate to determine the value of the real estate as you do the business, you're going to seriously overvalue the business. One more area that we need to deal with in this business valuation area, particularly in something like a C-store or a restaurant, where there's a lot of cash involved. In my experience as a business appraiser and business broker now for the last 23 years, many owners of C-stores, particularly things that are not part of chains, don't have great systems in place. Some of the cash, sometimes a great deal of the cash, does not make it into the register. In other words, then you're going to have a seriously underfunded income statement. The kind of things that we're going to ask for when we're valuing this business, we're going to demand the last 5 years' income tax returns, as well as whatever financial information there may be. Most C-stores in this case are not going to have CPA-prepared financial statements. They're probably going to have a tax return at best. Now, if it's a sole proprietorship, you're going to ask for and get copies of the Schedule C. I want the entire tax return, not just the Schedule C. You want the depreciation schedule, everything going with it. If it's a limited liability company or a corporation, then you want the corporation tax returns or the partnership returns, whatever they may be. Now, the owner of the store is probably going to tell you something along the lines of, well, gee, you know, the tax returns show $300,000 of gross income, but there's this other $150,000 that I pocketed. And they're going to want you to use that in determining the value of the business. You cannot. You must only use the income that you can actually verify. So in other words, what I typically tell someone that wants to sell this C-store that's done this is, well, you've already been paid for that part of the business that you've stolen the money from. Because a buyer is not going to give any kind of return or regard for any kind of income that cannot be proven. Now, another thing, in some states where you have sales tax records, you can ask for and get copies of the sales tax returns. Now, if the owner of this store is silly enough to file one amount on the sales tax return and a lower amount on this tax return, then you could still use the sales tax returns. However, if they've done that, they've committed tax fraud, in which case they've got some serious other problems. I do a lot of divorce work, and it's not uncommon for me to do something like have someone show up at court saying, well, but he or she, pointing the finger at each other, takes all this money out of the business. And my response to them and their attorney is simply, well, do you want to go on the stand and admit under oath that you've committed tax fraud? The judge will sentence you on the spot, put you in jail, as well as turn you over to the IRS. In this case, you may want to consider settling if you've done that. And that's not an unusual occurrence. What you now need to realize, though, is you're only going to be able to value this business based on the actual records that can be proven. But you can use some industry ratios to try and determine whether this thing really makes sense. And you can try and get an idea of whether the person really has skimmed just a little or a lot. If they've skimmed a lot, then they have some problems. Now, they may want to consider going back and amending their returns and admitting what's there, but again, you have to be careful when that happens, because then now that they're trying to sell the store, they may not be honest there as well. My opinion, if they've lied to the government, they're going to probably have no problem lying to you. Now, the problem you have when you're looking at a C-store, particularly trying to split out the real estate and the business value, is, as a business appraisers, we're not, of course, competent to determine the value of the real estate. So we have to come to the real estate professional and ask them, what in the world is this real estate portion worth? But what we need to do is we need to have someone that's qualified tell us the value of the real estate and the value of the land and building as if it were leased. As we mentioned previously, we're going to use the net cash flow of the business, we're going to use the forecasted net cash flow of the business, and the capitalization rate that we've determined, and we're going to come up with a value of the income, from the income approach, or income method rather, of what the value of the business assets are. We're going to compare that now to what the value was under this adjusted book value method, and see if there's a difference. If the value of the income method is higher than the floor value come up with the asset approach, then we probably have some goodwill. If it's less, then we're going to have to consider liquidation as a possibility. Also, other methods that business appraisers would use is from a market approach, which is what you call sales comparison approach. We would call it a market approach. We do this very differently, in that we're typically going to use some nationwide databases that are going to give us some indications of value by price to gross sales and price to earnings, typically. And we're going to try and use those to come up with the value of the overall entity. Again, when we're doing something like a C-store, we have a problem with this method because it doesn't split out typically the value of the real estate and the value of the business. So we're going to get a combined value, similar to what you would do in a sales comparison approach on a lot of these things that actually sold as a business real estate. So that I'm going to, if I'm doing a C-store, I'm going to give much less weight in my reconciliation than I would the other methods. Another method we need to talk briefly about is the excess earnings method. This is a hybrid method that's sort of a combination of both the asset approach and the income approach. What it's designed to do is to yield the value of the intangible assets. And it's very valuable from that standpoint. The way this method works is we come up with, again, an income stream. It should be probably net cash flow. And we're going to then also have the value of our tangible assets. This is determined from our adjusted book value method. We're going to come up with this value of what the floor value of the business is. Let's just use an example and say that it's $50,000. We now must assign some type of rate of return to those tangible assets. That's the first problem. Most appraisers use 10% because that's what was used in the Revenue Ruling 68-609 that codified this method by the IRS. However, that rate should be some type of a return that's reasonable on those tangible assets. Other people will use maybe a borrowing rate, like a prime plus 2 or 3, plus another little bit of a return for the equity portion of invested. In other words, there's no really good handle to hang your hat on. Somewhere between 8 and 12% is kind of the norm. Then after we've figured this return on the tangible assets, let's say it's $50,000, let's just say it's 10%. That would mean $5,000 of our income stream is allocated to the tangible assets. So if we had net cash flow of $40,000, and $5,000 of it is allocated to the tangible assets, that will leave us $35,000 that is a return to the intangible assets. Now, to develop the rate that we're going to use, because we have to have a excess earnings capitalization rate, again, we're going to make some subjective decisions. Typically, most people use something around 33%. Again, that's about what was used in the revenue ruling. And that's probably a fairly reasonable guess for a C-store, or something along that line. But what you must realize is the discount rate that you use to capitalize the excess earnings has got to be higher than the discount rate that you used in your income approach. So if you use 33% in your income approach as the capitalization rate, the rate that you use in your excess earnings method for excess earnings has got to be higher. And it's got to be quite a bit higher, because the intangible assets are much riskier than are the overall blend of all assets. So if we used, say, 30% as a capitalization rate to develop our income approach, we would probably have to be in the 40 to 45% for excess earnings. Or if we used 20% as our discount rate or capitalization rate for the income approach, maybe the 33% would be reasonable to use in this excess earnings method. So after we would then capitalize the excess earnings, we would then come up with this value, to which you could add the value of the under the adjusted book value method, this value of the tangible assets, to this excess earnings method to come up with the value of the entire company. And that's often done.